Bitcoin is not crashing right now. And that is exactly why this moment is dangerous. When a market collapses, the fear is easy to see. The red candles are obvious. The panic is obvious. The headlines are obvious. Everyone suddenly understands that risk is real. But the more difficult moment is when Bitcoin does not collapse, when price simply stays trapped, when the chart looks quiet, when traders start to relax, and when the market begins pretending that nothing serious is happening. That is when the real signal can become invisible. Right now, Bitcoin is not just moving as a crypto asset. It is moving like a liquidity instrument. That means the question is no longer only, is Bitcoin bullish or bearish? The real question is capital actually willing to chase Bitcoin here? Because if liquidity is strong, Bitcoin can absorb fear, rebuild momentum, and push higher. But if liquidity is selective, if money is flowing into other parts of the market, or if institutions are waiting instead of buying, then Bitcoin can stay stuck even while the broader market looks healthy. This is the trap. A flat Bitcoin chart can look safe, but sideways price does not automatically mean strength. Sometimes sideways action is accumulation. Sometimes it is distribution. The difference is not the shape of the candle. The difference is the flow behind it. If large buyers are absorbing supply, the range becomes a base. But if buyers are absent and the price is only holding because sellers have not fully attacked yet, then the range becomes a waiting room before the next move. The first pressure point is the Federal Reserve. Many traders only focus on the rate decision itself, but that is not enough. A pause is not the same thing as a pivot. The Fed can hold rates steady and still sound restrictive. It can avoid hiking and still refuse to promise easier liquidity. It can keep the headline calm while the message underneath remains tight. And for Bitcoin, that distinction matters. Retail traders often hear "no rate hike" and immediately assume that risk assets should rally. But institutional money does not think in headlines. It looks at real yields. It looks at the dollar. It looks at financial conditions. It asks whether borrowing is becoming easier, whether liquidity is actually improving, and whether the macro backdrop supports adding risk. If those signals do not line up, then Bitcoin does not get a clean green light. It gets hesitation. That is why the tone of the Fed matters more than the headline. If the Fed sounds patient but still worried about inflation, liquidity does not suddenly become abundant. If yields stay firm, if the dollar refuses to weaken, and if the market realizes that rate cuts are not guaranteed, then Bitcoin may struggle to attract aggressive capital. Bitcoin does not need the Fed to be perfect, but it does need the market to believe that conditions are becoming easier. Without that belief, every breakout attempt can become fragile. The second pressure point is ETF flow. Earlier in the cycle, the Bitcoin ETF story was simple. Institutional demand was absorbing supply. When ETF inflows are strong, dips are easier to defend because the market can point to a real buyer underneath the price. But when ETF flows weaken, slow down, or turn negative, the structure changes. Bitcoin no longer has the same automatic demand story. It has to prove that fresh capital is still willing to enter. This is where many people misunderstand the market. Bitcoin does not rise only because people believe in it. It rises when belief turns into capital. Narratives can create attention, but flows move price. If ETF demand is strong, then Bitcoin has support. If ETF demand is weak, then the market has to ask a much harder question. Who is buying the next breakout? Is it institutions? Is it long-term holders? Is it leveraged traders? Or is it simply retail chasing another candle too late? That question matters because Bitcoin is now competing for capital. It is not only competing against fear, it is competing against opportunity. If AI stocks are moving, if semiconductor names are strong, if Nasdaq leadership is attracting momentum, then money has choices. Capital does not have to sit in Bitcoin. It can rotate into the part of the market that looks cleaner, stronger, and easier to justify. That does not mean Bitcoin is dead. It means Bitcoin has to earn attention again. In a broad liquidity wave, almost everything can rise. Bitcoin, tech, growth stocks, speculative assets, all of them can move together. But in a selective liquidity environment, money becomes more careful. It does not buy every risk asset equally. It chooses winners. And if Bitcoin is lagging while tech is leading, that is not a small detail. That is a warning that liquidity may be going somewhere else. This is why the next phase is so important. If Bitcoin holds support, ETF flows stabilize, yields stop pushing higher, and the Fed avoids a hawkish tone, then Bitcoin can rebuild a floor. In that scenario, the sideways range can become constructive. It can become a base for the next move higher. But if the Fed stays cautious, yields remain elevated, ETF demand fails to confirm, and capital keeps rotating into AI and tech instead of crypto, then Bitcoin may remain trapped until one support level finally breaks. The key is not to watch Bitcoin in isolation. Watch the chain reaction. Watch the Fed tone. Watch the 10-year yield. Watch ETF inflows and outflows. Watch Nasdaq leadership. Watch whether Bitcoin moves with risk assets or whether it lags behind them. Because if stocks rise and Bitcoin cannot follow, that is not strength. That is a signal that the market's liquidity is selective. For the calm metrics, the message is simple. Do not be fooled by silence. A market does not need to crash to be under pressure. Sometimes the danger is when price holds, but liquidity does not return. Sometimes the warning is not a giant red candle, but a slow failure to attract new buyers. And right now, Bitcoin is sitting in exactly that type of moment. Bitcoin is trapped between three forces: a Federal Reserve that has not clearly opened the door to easier liquidity, ETF demand that still needs confirmation, and a stock market where AI and tech may be offering capital a more attractive short-term trade. Until those forces align, Bitcoin is not free. It is waiting for proof. And that is the uncomfortable truth. The next major Bitcoin move will probably not be decided by one headline or one candle. It will be decided by whether capital comes back with conviction. If liquidity returns, Bitcoin can recover fast. But if liquidity keeps choosing somewhere else, then the calm on the chart may not be safety. It may be the warning before the market finally makes its decision.